Hello and welcome to Westferry Times. I'm Emily, your host, and thanks for tuning in for another deep dive. Today, we are really getting into something that, well, it's on everyone's mind, isn't it? The tricky relationship between inflation, interest rates, and how it all hits your wallet, your business, the whole British economy, really. I mean, you see the effects everywhere, the price of your weekly shop, what's happening with mortgages. It can feel pretty overwhelming. So what is actually going on here? How are these rising interest rates affecting households, affecting businesses day to day? And crucially, is the Bank of England's plan, raising rates, is it actually working? Is it bringing inflation down? Or are we seeing maybe some unintended negative effects? To help us unpack all of this, we're joined today by Mark Ellis. He's an economist from the highly respected Institute for Fiscal Analysis. Mark, thank you so much for being here.
Thanks for having me. Yeah, it's a really important topic. Happy to get into it.
Great. So our mission today really is to try and understand the mechanics behind it all, the reasons for these policies, and most importantly, the real-world impacts for you, our listener. Let's start with the basics then. Inflation. We hear that word constantly. But what's really behind the inflation we're seeing right now?
Right. So fundamentally, inflation is just the speed at which prices for goods and services are going up. Simple as that, really. But the current surge, it's got its roots in a few major global events hitting close together. You have to think back to the pandemic first.
Ah, yes, the supply chain chaos.
Exactly. Massive disruption worldwide. That created shortages, pushed up prices for all sorts of things. And then almost on top of that, you had Russia's invasion of Ukraine. That had a huge knock-on effect, particularly, as we all know, on energy costs and food prices, too.
And these aren't just abstract economic numbers, are they? This is felt directly.
Absolutely. It translates directly into, higher bills at the petrol station, much bigger checkout totals at the supermarket, and the cost of heating our homes. It's very real.
Okay, so faced with that, the Bank of England's main weapon, so to speak, is the base interest rate. Could you maybe walk us through how raising that rate is supposed to tackle inflation?
Yeah, that's their primary lever. When the bank raises the base rate, it essentially makes borrowing money more expensive. That applies right across the board, individuals taking out mortgages, maybe car loans, but also businesses looking to borrow for investment.
So the idea is to sort of cool things down.
Precisely. Higher borrowing costs generally dampen demand in the economy. People and businesses borrow less, maybe spend less. It also, theoretically, encourages saving because you get a slightly better return. So less spending, less borrowing. The theory is that reduces the pressure on businesses to hike prices, and that helps bring inflation back towards the bank's target.
It sounds logical, but it also feels like quite a blunt instrument, doesn't it? Using one rate to affect the whole diverse economy.
And it is. It absolutely is a blunt tool. And there's a real challenge with timing and lags.
Lags. You mean it takes time to see the effect?
Yes, a significant amount of time. The full impact of a rate rise announced today might not actually filter through the economy for, well, many months, maybe even a year or more. And the big risk there is accidentally tightening policy too much or for too long. That could slam the brakes on too hard and potentially push the economy into recession. It's a very delicate balancing act.
Okay, let's make this really practical. How are average households feeling the pinch from both inflation and these higher interest rates right now? What are the direct impacts?
Oh, the impact is very, very tangible for many. If you're a homeowner with a variable rate mortgage, or maybe your fixed deal is ending.
Yeah, I know people facing huge jumps.
Exactly.
Yeah.
The increase in monthly payments can be really substantial, hundreds of pounds sometimes. That puts a serious strain on budgets. And renters aren't escaping it either. Landlords, especially those with their own mortgages on the property, might face higher costs themselves.
And passes on.
Often, yes. They pass those increases on in the form of higher rents. Plus, you've got the relentless rise in the cost of just everyday things, food, energy bills, transport. So when your housing cost goes up and your food shop costs noticeably more, that leaves much less money for anything else. Disposable income gets really squeezed.
And what about people's pay packets? Are wages managing to keep up with all these rising costs?
That's probably the most crucial part of the puzzle right now. We have seen some wage growth, yes, but for most people, it just hasn't been enough to offset how quickly prices have been rising. Economists talk about real wages. That's basically your pay adjusted for inflation. What can you actually buy with your money?
Right, your purchasing power.
Exactly. And for many, maybe most, real wages are currently falling. So even if your salary number went up a bit, you're effectively worse off because prices went up even more.
Now, on the other side of the coin, we sometimes hear that higher interest rates are good for savers. Is that offering much comfort?
It's true, yes. Interest rates on savings accounts have gone up, which is definitely a positive if you have a decent amount of savings put away. But let's be realistic. For a huge chunk of the population who might be living paycheck to paycheck or only have very modest savings,
A slightly higher interest rate on a small amount doesn't really move the needle much.
it doesn't really compensate for the big increases in mortgage payments, rent, and the cost of living. No.
Yeah.
The benefit of higher savings rates really accrues more to those who already have significant savings buffers.
Okay, let's just focus slightly to businesses, particularly perhaps the small and medium-sized ones, the SMEs, often called the backbone of the economy. What challenges are they wrestling with?
They are definitely navigating a very difficult environment.
Oh.
Higher interest rates mean higher borrowing costs for them too. So if a business wants to borrow to invest in new equipment, or maybe expand, or even just manage its day-to-day cash flow through an overdraft, it's suddenly much more expensive.
And at the same time, they're customers.
Their customers are feeling the pinch too. So consumers are becoming more cautious, cutting back on spending. It really is a double whammy for many businesses. Higher operating costs and weaker customer demand.
We are sadly hearing more stories about businesses, struggling or even closing down. Is there a direct link to this economic climate?
Yes, unfortunately there is. And certain sectors seem particularly vulnerable. Think about retail, hospitality, pubs, restaurants.
Things people cut back on first.
Often, yes. Discretionary spending. So they feel the impact quite quickly when household budgets tighten. The construction sector as well, which often relies heavily on borrowing for projects, is also facing significant headwinds. We are seeing a noticeable rise in business failures in these kinds of areas.
For the businesses managing to keep going, what are they doing? What sort of coping strategies are they using?
Well, many are forced to look very hard at their costs. That might involve trying to streamline operations, make efficiency savings. Unfortunately, sometimes that can lead to difficult decisions like reducing staff numbers or freezing hiring.
And what about prices? Are they passing costs on?
That's the other major lever, yes. Facing higher costs themselves, energy, supplies, borrowing, they might feel they have no choice but to increase their own prices. But of course, that then risks contributing to that vicious cycle of inflation we mentioned earlier, where rising prices lead to demands for higher wages, which fuels further cost pressures for businesses, and so on. It's a tough loop to break.
Okay, another big area heavily influenced by interest rates is the housing market. What are we seeing there? What's the current picture?
We're absolutely seeing a cooling effect. No doubt about it. The number of actual house purchases, the transactions, has fallen quite markedly. Mortgage approvals are also down significantly.
So it's harder to get a mortgage and fewer people are buying.
Essentially, yes. First-time buyers, in particular, are facing even bigger hurdles. Higher mortgage rates combined with the general cost of living squeeze make saving for a deposit and affording the monthly payments much harder. And, as we touched on, existing homeowners coming off fixed-rate deals taken out when rates were ultra-low, well, they're facing a potential payment shock. Monthly payments could jump significantly.
There's been quite a bit of talk, even fear perhaps, about a potential housing market crash. Is that something we should be genuinely worried about, like 2008 all over again?
Well, most analysts think a full-blown crash on the scale of 2008 is probably unlikely. The situation is different now.
How so?
Things like stricter lending rules since then, and also a more fundamental issue, a long-term undersupply of housing compared to demand in the UK. That tends to support prices over the longer run. However, that doesn't mean prices aren't falling. We are seeing a price correction, a downward adjustment, especially in areas that saw very rapid price growth previously. Affordability is just stretched too thin with current rates.
And what about renters in all this? If buying is harder, does that push more people into renting?
It does, yes. That's one of the difficult consequences. As buying becomes less accessible, demand for rental properties increases. At the same time, as we discussed, some landlords are facing higher mortgage costs on their buy-to-let properties, and they often look to pass these costs on to tenants.
So more demand and potentially higher costs being passed on.
Exactly. It creates upward pressure on rents. We've seen really sharp increases in rental costs in many cities, reaching record levels in some places. It's making the affordability crisis even tougher for renters.
Right. This brings us to the really big question then. All this pain, higher mortgage payments, squeezed businesses, worried renters, is the Bank of England's strategy, the medicine, actually working? Is it curing the inflation problem?
That is indeed the million-dollar question, isn't it? We are seeing some positive signs. Headline inflation has come down quite a bit from its peak, which was over 11%.
But still well above the target.
Still significantly above the bank's 2% target, yes. And it's crucial to remember that lag effect we talked about. Monetary policy works with a delay. The full impact of all the rate rises we've already seen over the past year or two is likely still feeding through into the economy. You haven't felt the full effect yet.
So there's a risk they might have already done too much.
There is. That's the risk of over-tightening. Raising rates too high or keeping them high for too long, and unnecessarily slowing down economic activity more than needed, perhaps even causing a deeper recession.
So what key things will the bank be watching like a hawk now to decide what to do next? What are the crucial data points?
They'll be looking really closely at a whole range of indicators. Core inflation is a big one that strips out the volatile elements like energy and food prices to give a sense of underlying, stickier price pressures. Wage growth is another critical factor. Is it high enough to risk embedding inflation, or is it cooling down? They'll look at consumer spending figures. Are people still spending or really tightening their belts? And of course, they can't ignore global factors. What's happening with oil prices? Commodity markets worldwide, all of that feeds in.
It sounds incredibly complex, a real balancing act.
It is a very, very delicate balancing act, trying to thread the needle between getting inflation down without crashing the economy.
Is there perhaps any room for maybe cautious optimism? Any light at the end of this tunnel?
I think there are some glimmers, yes.
Hmm.
As we said, inflation is clearly trending downwards now, even if it's still too high. Energy prices have also thankfully stabilized, even fallen back somewhat from their peaks. If these downward trends in inflation continue, especially core inflation and wage growth, well, then the conversation could start shifting later this year or next, towards when the bank might feel able to start cutting interest rates again.
And that would provide some relief.
That would certainly provide some welcome relief for mortgage holders and potentially boost business confidence, yes. But we're not quite there yet.
Mark, looking ahead then, based on everything we've discussed, what's your kind of key piece of advice for different groups trying to navigate this? Say, for consumers generally.
For consumers, I think it really has to be about staying informed about your own finances and budgeting very realistically. Know where your money is going, especially with costs still high.
And for homeowners, perhaps those worried about their mortgage.
Absolutely crucial. Talk to your lender early.
Mm-hmm.
If you're on a variable rate or your fixed deal is ending soon, don't wait until the last minute. Explore your options, see what deals are available, or if you foresee difficulties, discuss them proactively.
Okay. And for businesses?
For businesses, particularly SMEs, prioritizing cash flow management is key right now. Be cautious about taking on significant new debt or making big, risky investments unless the potential returns are very clear and robust. It's a time for careful planning.
And finally, maybe a word for policymakers, the government, the bank.
I think there remains a strong case for considering targeted support for the most vulnerable households. Those on the lowest incomes are disproportionately hit by high inflation, particularly for essentials like food and energy. General measures like rate rises hit everyone, but specific support can cushion the blow for those struggling most.
Thinking longer term, do you see any potential shifts in how the Bank of England or central banks generally might approach tackling inflation in the future, given the sort of unique shocks we've had recently, the pandemic, the war?
That's a really interesting question, and there is certainly a lot of debate among economists right now. The experience of the last few years, where inflation was driven so much by global supply-side shocks rather than just excess domestic demand, well, it has raised questions about the limitations of relying almost solely on interest rates.
Because interest rates mainly affect demand, right?
Primarily, yes. They don't directly fix broken supply chains or lower global energy prices. So, we might see perhaps more discussion about a need for a more integrated approach in future crises, maybe closer coordination between monetary policies and the bank's interest rates and fiscal policy government taxing and spending to target specific inflationary pressures more effectively. It's an active area of discussion.
Mark Ellis, this has been incredibly illuminating. Thank you so much for breaking down these really complex economic forces in such a clear and understandable way. Really appreciate your time and expertise.
It was my pleasure. Thanks for the great questions.
And thank you for joining us for this deep dive here on Westferry Times. We hope you found this discussion on inflation and interest rates valuable. If you did, please do consider subscribing to our channel for more deep dives into the issues that matter. Understanding these economic currents, it's just so vital right now. Thank you for watching Westferry Times. Our